Welcome back to the Fostering Financial Victories podcast. I should start this with a disclaimer. So last time you were here, Rand, the world was on fire.
It was
right?
wild.
The market was going crazy.
Yep.
You're back, and we're going to talk about the other taboo topics. So you were also here with your wife, and we talked about money and marriage.
Man.
So we're going to talk about politics and not really talk about politics. So thanks for joining us, Rand. We're going to try to talk through a little bit of the historical look back on some of the impact from the presidential elections in years past, because we're getting a lot of questions on it. People want to know about it. So thanks for joining us, and we're going to go through this and try to unpack some of this a little bit. So where do you want to start?
Well, let's just kind of start with what the question is, right? Like it's
the question.
It's a tough question.
Oh yeah, we're getting it a lot. So what's the market going to do with the election?
And if we knew that answer, we probably wouldn't be in this studio at 7:45 a.m. if we knew that answer. But in all seriousness, I mean, it'd be a best guess, and I don't like guessing.
Yeah.
I'm not a big fan of guessing or just taking a flyer with that question. So from our perspective, what we like to do is just look at the data and look at the at how the markets have performed in past market elections to help us understand what it could do in November. Doesn't mean it will do that, as we know, because past performance is never indicative of future performance. But just to have an idea of what to kind of expect a little bit.
So I know when we were kind of prepping for this discussion to figure out how to unpack this, part of what we talked about was the most recent election was 2016.
Mm-hmm.
And do you remember, what feels like decades ago now, especially after this year, but how the expectations were going into that one as well? Kind of seemed kind of similar.
Yeah. So 2016, I can remember like it was yesterday. And the reason why is because leading up to that election, the thought process by most of the analysts was that, obviously the markets do not like uncertainty. But the thought process was that if Hillary won the election, then it was less uncertainty than if Trump won the election, because Hillary was a part of Obama's administration, same party, et cetera. And so that was kind of the thought process of most analysts. Then election night happens, Trump wins, Dow futures go down 600, 800 points.
Way down.
Didn't sleep at all that night. And I'll never forget, like I was in the office at 4 a.m., had everybody's clients list that we're going to call and just touch base and just reach out to everybody. And we had a game plan. We had a meeting with all the wealth coaches. We had a game plan to do that. Markets open at 9:30, and I'm still in my office. All right, I'm going to call this person, that person, that person. And then I'll never forget Paul, whose office was down the hall. He runs out of his office. He screams down the hall. He's like, "Markets are up." I was like, "No way!" And then, sure enough, markets were up that day, and the rest is kind of history.
Yeah, and what people thought would happen didn't really come to fruition.
Right.
And if you go back, kind of looking at this year, as crazy as the market and the economy and what we've seen and experienced so far, all the uncertainty still very unpredictable with what people thought might happen.
Right.
So I think it just kind of goes back to that point. And, we did a lot of digging and got some resources from Peter, who is a vital part of our team. And he put out a 3-part series on what his kind of his research and his take on it was. So let's get into that a little bit.
Yeah. First of all, if you haven't read this series, it's unbelievable. Go to our website. Go to the resources section, the news section, the 3-part series. It's really great work.
Quick read too. It doesn't take you but a few minutes.
Yeah, it's very, very quick. But basically what we found was that what we're experiencing right now obviously has never happened before. A pandemic's never happened before. But there are things in the past that at that time had never happened before. There are things, there were uncertain times in the past, and specifically uncertain times during during election year.
Yeah. So the first part of that series, Peter went into the details of kind of the presidential cycle hoax, I guess is how he termed it.
Yeah.
And the thought there was that in the first 2 years of an administration, you would see, massive growth that takes place throughout those 4 years. And really, he made a comparison to the current administration and how this year, being in the fourth year, typically this would be a really good year in a presidential cycle, but it hasn't been because of the pandemic side of things. But it kind of goes back, as he looked back through history and went and picked out a couple things. The one that you started this whole off with a few days ago was the Truman transfer.
Yeah, so I'm going to steal something from my father-in-law. So my in-laws were in town with us, and he was reading a book called The Accidental President, and it's about Harry S. Truman, and he was after FDR. So FDR passed away, and Truman was the vice president. And what really stood out was the back of that book, the summary, the first 4 months when Truman was in office. And I'm going to read a couple of things that happened in the first 4 months.
That was 1945 for all you history buffs.
Yeah, these first 4 months are completely wild. So the first was the fall of Berlin. The second was the victory at Okinawa. Then the controversial decision to drop an atomic bomb.
Which I read on this as well. He had no idea it was even happening, being created before he stepped into being president.
Yeah, could you imagine stepping into office?
Hey, we have this thing.
And he's like, what? and then from there, the World War II ending and conquering the Nazis. But even bigger than that, or not bigger than that, but interesting is with World War II ending, the Cold War begins, and his allies, who was the Soviet Union, now becomes his enemies. So those first 4 months of his office were unreal. A lot of uncertainty.
Yeah, a lot.
A lot of, hey, this has never happened before. And what's interesting is that the S&P was actually up 31% that year.
So, okay. So you got the atomic bomb being dropped. You've got the end of the World War II, and the market goes crazy in a good way, right? So obviously there's probably a lot of spending that took place in there too to drive profitability. Yeah. So we were talking through this, on November the 4th, in just a couple weeks, our company's going to just immediately stop selling goods to consumers depending on a certain candidate winning or losing.
There's no way.
No chance.
Like I got Starbucks coffee in my mug here, and
you sure that's not bourbon? I mean, we can throw that in.
Well, yeah. Depends what day, right?
Yeah, that's right.
but yeah, like Starbucks coffee, like they've raised the price on this. So I always get the Venti Blonde Roast. They've raised the price like 4 or 5 times since I first started getting it. It was $2.15 like 4 or 5 years ago. Now it's like $2.70. Guess what? Still buy it. Another thing, like, do you think people are going to stop going to Lowe's, Home Depot?
Yeah. I think from the consumer perspective, I know a lot of people are somewhat worried about what happens on the administration side. Yeah. What type of policies get put into place, or do they stay in place where they are? We talked a lot about this in terms of what is the impact, and this was in part 2 of Peter's series, with presidential influence upon the economy. Okay, so fiscal policy is what the president and the administration and the Congress and the Senate and all those have impact on.
It's basically like the laws they put in place, taxation, the way the government raises revenue.
So from 1950 to right now, so again, I'm going to steal this from Peter, okay? He did a comparison of Democrat and Republican houses or administrations on the impact of quarterly GDP growth and productivity growth. So you've got those numbers sitting in front of you.
Yeah, so GDP is essentially just how strong the economy is growing. It stands for gross domestic product. And what's interesting, so the average quarterly GDP growth, if a Democrat was president, was 1.4%. The average quarterly GDP growth, if a Republican was president, was 1.5%. 5.
Okay, so I know what's happening right now. People are on the left or right thinking, "Ha, we won," or "Man, that's not true." Okay, so we're gonna return the favor. The productivity growth number for the Democrat side of things was 1.8%, and for the Republican was 1.7. So it's a wash. Okay, they basically cancel each other out from a historical look back. So kind of to go back to that historical piece. So in 1952, you had Eisenhower in office from a presidential election. The S&P was up 12%. On the heels of the truce talks with the Korean War failing. So a lot of unrest. People wanted the war to end. It didn't happen.
Yep.
S&P up 12%. 1964, Lyndon Johnson, the civil rights movement.
Yep.
A little unrest maybe, just a tad.
Big time.
Okay. S&P was up 13%. 1976, Jimmy Carter. Economy's in a recession. S&P up 19%.
Mm-hmm.
So you look back on the historical aspect of things, and it's really hard to make a bet on what you think might happen from a future expectations when you have such a track record to go off of. And you know that, I mean, that's how we somewhat base all of our decisions off of when it comes down to making recommendations.
Yeah, I mean, like even going back to that, you know, the U.S. economy, we're talking about a $21 trillion
Big
economy.
number.
So let's say, for example, taxes increase. And what that means is if taxes increase, it's got to be a big enough increase where people are discouraged to invest money. Will that happen?
I have no idea.
No idea.
No clue.
It hasn't happened yet, but who knows?
Well, and back to the fiscal policy side of this. So the other side of the table is the monetary policy, right? So that's all directed from the Fed. And that's been proven to have more of an impact on the economic status of the economy than even the fiscal side.
Yeah, so the best way to think about this is like monetary policy. So the Federal Reserve basically increasing or decreasing interest rates. It's quicker for them to implement and has a quicker effect on the economy, but it doesn't have a lasting effect, if that makes sense.
So let's talk through what that does in the economy when the Fed move interest rates up or down.
Yeah, so think of like so if interest rates if they move interest rates down, then basically money is cheap. So if money is cheap, it encourages borrowing. It encourages business owners or just people in general just to borrow from banks because it's cheap to borrow.
You're saying cheap being that there's not a lot of debt service to be leveraged.
Yeah, exactly.
Okay.
Exactly. So because it's cheap to borrow, that also means there's more money in businesses or individuals' pockets that they either use to spend in the economy or invest.
I think prime example is right now what you're seeing in the real estate world.
Yeah.
Okay, so interest rates being really low, people are excited about going and upgrading houses, maybe buying a bigger house because they can get more money and it's not as big of a debt service to service that loan.
Yep.
So it's a prime example of what we're seeing right now. Interest rates go up. So I think back in the 80s, interest rates were, like 12, 13, 14%?
Yeah, I think I saw a mortgage of like 18%.
Yeah, so not as much maybe rush to buy houses probably.
Not as much discretionary money in people's pockets.
It's true too. Yeah.
But on the flip side of that, fiscal policy, like we said earlier, that's where the government, implements laws or taxes, et cetera. That's what the president has more control over, if that makes sense. But the key here is it's much harder to implement fiscal policy because you got to go through the different checks and balances. But because it's much harder to implement, once it's implemented, it has a more lasting effect on the economy.
That's a great point because really the president can only make suggestions. If his party doesn't have control of the House and the Senate or either of those, going to be really hard to get anything pushed through.
Yeah.
Yep. So that's a great point. And all three of those are up for grabs.
Fun times.
All right. So as we kind of get into some of the expectations for people, that's the biggest thing I think you have to keep in check, right? What do you expect your investing philosophy to do? What is it supposed to do?
Yeah.
This is kind of a rehash of what we talked about back in March when the market was in flames.
Mm-hmm.
Really, the time horizon of $1. What are we saving the money for?
Yeah, I think there's two components to this answer for two different stages of life. The first would be the accumulation phase. This is the phase where you're working in your prime years, you're saving money, and then the other phase is the distribution phase. This is where you are approaching retirement or in retirement, and instead of saving money, you are spending and withdrawing money from your portfolios. But the key here, this is what our wealth coaches, what you guys do such a great job of, is talking about the time horizon for use of the dollar you're investing. And so what I mean by that is, again, going back to my statement at the start of this, I'm not into a guessing game or like flip of the coin type scenarios. So I like scenarios where the odds or the probability are really in our favor for success. And we talked about it in March, but BlackRock did a great study that talks about, depending on the time horizon, whether there is a positive or negative return. So basically on a 5-year time horizon, actually, let me take a step back. On a 1-year time horizon, so if I invest money today, I take it out 12 months from now, my probability of a positive return is 75%. My probability of a negative return, 25%.
Yep.
If I increase that to a 5-year time horizon, so I invest money today, take it out 5 years from now, my probability of a positive return increases to 88%. On a 10-year time horizon, invest money today, take it out 10 years from now, my probability of a positive return increases to about 96%. So I like those odds of 5 and 10 year much, but going back to accumulation and distribution phase, I think the key is, and what y'all talk about with all our clients, is if we're going to invest money in the stock market, our thought process is it's got to be 5+ year money. If it's 1 year money, 2 year money, we really need to think if the stock market is the best place to put those dollars, regardless of where we're at, regardless of election year, et cetera. If it's a 5+ year play, the odds are really in our favor.
So what I'm hearing from you is really trying to separate statistics and emotion, and that's really difficult.
It's hard.
Okay,
Yeah.
and this year I think has shifted more people towards the emotional prism than anything prior. A lot of studies being done about new investors this calendar year, and a lot of theories of, hey, are these dollars that are coming into the market dollars that used to be going towards sports gambling? And like I've seen all kind of stuff where people are day trading and they used to be gambling on sports.
Yeah.
And they couldn't do that for a while.
Yeah.
People have either seen a really good success rate this year, depending on what they did early in the year, or they got laced, depending on what they did earlier in the year. So the emotional aspect is really high. I understand that. I mean, goodness gracious. We talked about it earlier. Everything is in just disarray all the time.
I mean, just think about, March and April. One of the things that I encourage myself, our team, everybody to do is kind of just keep a journal. Like, what were the decisions that we made as wealth coaches leading up to March and February and January, but also what were the decisions that we made in March and April, just keeping that journal and going back to that, because there's going to be more times when there's volatility and there's uncertainty, but it's good to go back to that journal, if you will, just to kind of remember, okay, back in March I did this and it worked out well, or I did this and did not work out well,
right.
Just to learn from that.
Yeah. Okay. So with the accumulation side of where most people might be thinking, or they may be in that preservation of capital. If they are 5 years away from needing to spend it, like should they be thinking anything different? It sounds like no, but maybe
a little bit. So, so if we're 5 years away, then it is kind of that transition from accumulation to distribution phase. And one thing that our team and the wealth coaches do a great job of is organizing those dollars that are in the invested portfolio based on the time horizon for when they will be withdrawn. So we call that, it's our 10-year runway. And it's all built around the financial plan. So number one, having the plan. Then number two, building the investment strategy and 10-year runway around the financial plan. But the key here is having two main buckets. The first bucket is dollars that are non-correlated to the stock market. A lot of times that is cash. The second bucket is dollars that are invested because we do need to invest money, because if we don't, then we have longevity risk. We have risk of outliving our money. But as we are approaching distribution phase, having between 3 and 4 years of living expenses set aside in that non-correlated asset like cash, we can weather these types of storms where we're not forced to sell invested assets at depressed value, because that's really how you lose if you have negative compounding.
So if you're 5 years out and you're thinking, I may need to spend and not necessarily from retirement, but just I may need to spend dollars in the next 5 years, whether it's going and buying a car, whether it's putting kids in school. I think the big thing is to really evaluate whether or not that you feel comfortable taking that risk of the markets, because statistically it should be okay, what you were saying from BlackRock, but still a 12% chance it could not go your way, right? Yeah. So there are still the odds there. All right. So the timing of the investing and holding dollars, this was in part 3 of the series that Peter did. So we went back and looked at a run of people when they got out of the market right around the election and got right back in after, in kind of that time frame, and what happened.
Yeah, so basically this is really cool. So sorry, I'm going to geek out a second. But scenario 1 is someone who stayed invested. So they had $10,000 on January 1st of election year, invested it, and they stayed invested throughout the 4-year presidential cycle.
Okay.
Scenario 2 is someone who sat on the sidelines. So they also got $10,000 on January 1st of the election year, but they didn't invest it until January 1st of the year after the election. So they waited for the election to happen and then invested their $10,000. They also held it through the presidential cycle. The average returns for the first scenario, investing $10,000, leaving invested throughout, the average returns was about $15,800. So I invested $10,000, it grew to $15,800. The average returns for the scenario 2, where they sat on the sidelines, again, got $10,000 but waited until January 1st after the election to invest it, the growth was $14,900. So a difference of about $1,000. It doesn't sound like that much, but this is pretty cool. So Peter said, okay, what if we look back over the last 10 election cycles? What is that cumulative difference?
So looking back 40 years,
right?
With that same
scenario.
Okay.
Same scenario, either staying invested or sitting on the sidelines, and the difference was about $466,000, and that's important for not only accumulation phase, but also distribution phase.
Right.
Because if we're in distribution phase, you might think, hey, I can't afford for it to go down, but the risk that investors don't think about is that longevity risk, is that risk of outliving your money. If we're in accumulation phase, and we had 466,000
pretty
more,
big deal.
Might be able to retire a year earlier,
yeah,
or two years earlier, right?
Might be able to spend a little more.
Yeah, or spend a little more. Whatever.
Take an extra trip.
Yep.
Yeah, okay.
Yeah.
That's really neat. So again, I would encourage you guys to go to our website and seek this out. There's a 3-part series. They should take you 5 minutes at most to read each one of them.
And if you're not getting these emails,
yeah, let us know.
Let us know. We can get you on the list, and the team does such a great job with these emails.
We also are. We can plug this as well on a weekly basis. There's a market update that comes out from your staff, your team.
Yep.
So give everybody a shout on that.
Well, it's pretty cool. So it's 60 seconds.
Painless,
easy. You don't have to sit there and,
You don't have to watch us. It's not us.
No, yeah, but it's cool. Just 60 seconds on what we're seeing in the markets that week, that month. And it's on our Instagram, it's on the website, it's on YouTube. So definitely check that out as well.
Yeah, so I'll go ahead and give everybody the website. It's fostervictorwa.com. You can find anything that we've put out for resources and information on there. Our Instagram is Foster Victor Wealth Advisors. So we encourage you to follow us. Put some good stuff out. Hopefully it's helpful. Rand, I really appreciate you coming in and talking about this. We talked about politics, but we really didn't talk about politics. Nobody's fighting.
And maybe next time we'll talk about religion.
We could do that. We could definitely do that. If you have questions or suggestions on topics that you'd like for us to cover, please send us a note. You can email us directly from our website. Please subscribe to our podcast. You can see this in a video version on YouTube. Share it with a friend. Hopefully you enjoyed it. Thanks, man.
Thanks, guys. Appreciate it.
Information contained in this podcast was intended for general use, not to be used as specific advice. For content tailored to your personal situation, please contact one of our wealth coaches.